Welcome back to the Team Invest Wealth Builders podcast and another episode of Wealthy and Wise, our collaboration with Ausbiz. Each week, we step away from the daily market noise and take a closer look at what it really means to invest with discipline and clarity. On Wealthy and Wise, we break down the principles of value investing, exploring the difference between price and value and how to make rational, long-term decisions in any market environment. Our conversations focus on practical frameworks, not jargon, using real companies and real examples to bring these ideas to life. Whether you're a seasoned investor or just starting out, our goal is to help you think like an owner, not a trader, building wealth with patience, structure, and confidence. Thanks for joining us. Let's get started.
Wealthy and Wise is your guide to value investing, powered by Team Invest.
Hello and welcome to Wealthy and Wise. This week, megatrends. They are some of the most powerful forces shaping the global economy, from artificial intelligence and the energy transition to aging populations and digital transformations. But while these themes can drive extraordinary growth, they can also lead investors to overpay for a story. So how should value investors think about megatrends? Well, this week on Wealthy and Wise, we explore whether these powerful themes create genuine investment opportunities or simply fuel market hype. So let's start by adding some value. Well, megatrends do dominate the investment conversation, but do long-term themes translate into good investments, especially if the market's already priced in years of growth? So let's begin at the beginning to define a megatrend, why investors are drawn to them, and how to approach these really powerful narratives without getting caught up in that hype. Joining us is Andrew Coleman from Team Invest, and a very warm welcome to Ryan Joyce, who's joining us from Magellan. Ryan, if you don't mind, I'll start with you, because I think we can't assume that everybody knows exactly what a megatrend is when we're talking about it from an investment point of view.
Absolutely. So it is something that's not very clearly defined, obviously, and I think it means something different to different people. The perspective that we would take on it is, it's kind of in the name. It needs to be a big trend. I don't think that's necessarily dollars, although it tends to translate into that, but it's something that everybody feels. So it's probably a society-wide impact. You can go about your day, you'll see this mega trend and really feel this mega trend rather than it kind of being under the covers. The other part is it's not a cyclical thing. We often see cycles in markets. They might last 3 years, 5 years. When we're talking about megatrends, we're talking about something that is 10 years plus, multi-decade potentially in nature. And then the final aspect from, particularly from that investment lens, is it's something that's giving the opportunity to grow ahead of broader economic growth. It's an opportunity to, and it doesn't have to be meteorically faster, but healthily ahead of GDP growth for a long period of time, which is really what is attractive about them from an investment perspective.
Yeah, so I think that's really interesting because it's easy to say AI, a megatrend, but it's more than that. So do you think, Andrew, maybe that people are too quick to label something a megatrend?
Yeah, well, I think we're all human, right? It's fun to talk about things that are major and amazing and exciting and then move on to the next one probably faster than we should. But I mean, megatrends aren't new, right? I mean, the story of humanity has been filled with one megatrend after another megatrend. And society moves in those leap changes. So I don't think there's any question that there are megatrends out there. I think the interesting one to unpack today, though, is going to be that lovely question of, just because it affects society and us as consumers positively, does that mean that businesses and therefore investors in those businesses will be winners or losers? And how can you benefit from making sure you're on the right side of that ledger?
All right, well, let's park that for a moment because I've mentioned AI. We weren't going to get very far into this conversation without doing so, but electrification, aging population, those are examples, right? So they're attracting huge investor attention. But why do you think as an investor that markets are so drawn to these sort of narratives?
Yeah, I think there's a couple reasons. One, I think it's just very human. There's something about growth that's associated with winning. You want to be associated with that. It just feels good to be associated with these mega trends. And so I think that draws investors in. I think the other reason is very genuine reasons why investors are in markets are focused on these megatrends is if you look at the most valuable companies in the world, the NVIDIAs, the Googles, the Metas, the Amazons. These are the beneficiaries of either current megatrends, recent megatrends, and they've created enormous value for shareholders. And you probably don't have to go far in conversing with people to hear their story about a megatrend that, you know, played out very favorably for them. The other, I guess, less obvious dynamic for me is that growth is very healthy for companies. It just makes life easier for them. You can attract talent, you can pay people more, you can offer them opportunities to progress. So these growing businesses, even if it's not something that's meaning you're growing really fast, you talked about aging populations, you know, maybe that's a slight benefit to growth, but it's not something that's necessarily driving double-digit growth every year. But it's just this nice tailwind for a business that helps them just continue to grow in a healthy way and ideally deliver good returns for investors.
So what you're saying then is that a true megatrend can last decades. It can be a slow build. It can be a long-serving tailwind. But I think I'm correct in saying that markets often price these really quickly. So does that then create a mismatch between, you know, the story or the megatrend and valuation?
Absolutely. So I think you touched on something quite interesting there, which is the different pace of megatrends. So you can have a megatrend that plays out very quickly, very dynamically, and we see that more and more just given the interconnected nature of the world. Or you can have ones that are more driven by demographics, so aging populations, I'd say female participation in the workforce and more disposable income there. So these things naturally take a little bit longer to play out than maybe people, you know, getting Instagram and doing that. So particularly these innovation-led ones that lead to this steeper S-curve or pace of adoption of these megatrends can lead to volatility in investor outcomes and, you know, create some pitfalls that investors need to be aware of. And the way we tend to think about that is you might have an S-curve for this megatrend playing out, and that might 10 years, 20 years. But on the other side, you've got a kind of a hype curve. Gartner calls it the hype cycle. Often early in these phases, people assume you're going to get this very, very strong growth. It's going to penetrate very quickly, and they pay for those businesses on the assumption that that is the case. And what we often see is that it takes a little bit longer to achieve that penetration early on. We get there in the end, but it takes longer. And as people go through that initial phase of euphoria and some of that wears off, then, you know, they get a bit negative, the share price comes down, other negative narratives come in, maybe people abandon the trend altogether, some of the money gets sucked out of the sector. So it can create, even if you have this pretty steady adoption curve, if you didn't have public markets overlaid on it, you can get a lot of volatility just because of market sentiment and how investors are thinking about it.
Yeah, and this is where I would imagine a value investor would get cautious, right?
Yeah, I'm glad you brought up the Gartner hype cycle. I was going to if you didn't. I mean, the classic challenge of there's some form of innovation or trend, we reach a peak of inflated expectations as everyone thinks it's going to change the world and it's going to change the world tomorrow. Then, of course, things don't quite work perfectly because we live in a world where things don't work perfectly. And we suddenly all get scared and there's this huge, as Gartner called it, the trough of disillusionment. And then over time, the slope of enlightenment as people work out, actually, the trend is making sense. It's just taking time because people can't change their entire factory in a day and they don't change their lifestyle in a week. And we're slow as humans to adopt things, even if we should. And eventually we reach that plateau of productivity, which means as an investor, of course, you've got to ask what's the right time in that cycle per company to be making your investment, even if you believe in the trend. And of course, you know, I think Warren Buffett, he gets often complained about as having been left behind by trends, but I think he has the best track record of buying in the middle of that trough of disillusionment of anyone that I've ever seen, you know, in my studies, on the basis of he ignores the early innovation and inflated expectations. Prices go through the roof. Buffett says, I don't understand it. It's too hard for me. Stay out of it. Forbes writes another article of Buffett's lost it. And then somewhere 5 or 10 years later, he seems to buy the entire company for 10% of what it was trading at a few years earlier and makes 20% a year, compounding into the future as the megatrend plays out. That's the challenge as a value investor. How do you identify the trend, accept there's the trend there, you don't want to deny it, it's fact, but wait for the right time in the cycle to buy rather than getting caught up and overpaying early or waiting too long and missing out.
Yeah. Ring the bell. We've had our Buffett quote for the day. Okay. So, Ryan, are investments in megatrends then also something where you need to look for the enablers sometimes rather than the sort of, I guess, the headline generating companies?
Yeah, I think that is true. They often impact a lot of different companies. So your opportunity to gain exposure to that is not just limited to the first company that comes to mind. I would say markets have become a lot better at ferreting out all those different exposures. We've had baskets of ETFs being created that you can buy into AI or semiconductors or this and that. So a lot of those do get exposure to that, I would say, faster, or priced for that faster than what they did in the past. For us, I think where to look for is a couple things. First, if we're talking about a megatrend that's going to play out over 10 or 20 years, you want to make sure you are invested in the businesses that are quality businesses that are going to make money and increase their value as a result of that megatrend over that period. A lot of times when you have these breakout megatrends, it's a bit of a rising tide lifts all boats moment. Growth often gets conflated with quality. Oh, this business is fantastic. It's growing every year, 15%, 15%. And what we see is inevitably it attracts more competition. Some of those first mover advantages get competed away. And perhaps, it's not such a great business. Yes, it's exposed to that mega trend, but the value that's being generated for shareholders is not quite what was expected. And so we think you want to be very selective in identifying the high quality businesses to kind of ride that S-curve of adoption, because that's the exposure you're getting, and you want to stay attached to that line and not have competition or regulation or something else come and knock you off that trend.
So megatrends create winners, and we kind of talked about this in the previous episode, unicorns and dogs, but they also destroy sometimes incumbents. So how important is it, to think about this disruption risk emanating from megatrends, when researching and when investing in other companies sort of on the periphery or even in other sectors?
Yeah. Look, it's the flip side, and it's constant disruption. So I think it's very tempting to view the world as static and not take enough consideration into how that's changed. And yet we see industry after industry do get disrupted by this new trends. So we always need to be forward looking in our assessment of a business quality, their competitive position, all these factors. And really just take a view on how you think it's going to evolve. And it's difficult because it's not set in stone how this plays out. You've got big companies that are smart, that are also adapting to these environments to make sure they're exposed in the best way. And if we think of an example of that, bring it back to AI, Google getting caught maybe a little bit on the back foot in terms of having a chatbot service similar to ChatGPT initially. And since then, having really ramped up that pace of acceleration to come out with Gemini and AI overviews and integrate that into their product and actually accelerate the growth in their core search business. So again, you could look at that a little while back and go, yes, they were facing a bit of a disruptive moment here. How do we think they're going to innovate? Are they capable of innovating? And so it's not even necessarily industry by industry. You need to look company by company. Does this company have the right capabilities to innovate, to adapt? What are their advantages? Is it purely their product, for example, or do they have maybe something else like Google did in terms of distribution of their search product through the Apple ecosystem, existing users? That meant once they get the product in place, they can actually bring it to an audience very quickly. So it's a very important question, and it's a really fascinating thing about investing in our jobs is to figure out how that is going to play out. I think to the point you made, sometimes that dynamic phase, maybe you want to step back and wait to see how things play out, and then you can, as you said with Buffett, come in at the bottom of that S curve where maybe some of this landscape has sorted itself out. It's a bit clearer who the winners are. Perhaps you didn't, get you missed some of that upspeed there, but you could have been wrong on that as well. But you still have 20 years of compounding growth if you've identified the right company and they've established that competitive advantage to grow into.
So as a value investors, do you allow megatrends to guide where you look?
I think they influence your views on moats and risks. So when you're talking about this competitive advantages and the risks to a business, you'd be silly to completely ignore them because they exist. I mean, 150 years ago, Schumpeter referred to capitalism as the process of creative destruction. So, there is always risk to any investment, and technology or megatrends, demographics, etc., will all play an element in that creative destruction. But what's really fascinating is when you look at the biggest companies in the world by market cap, decade on decade on decade, about half of them in any decade you never hear of again. They're the ones that are the fly-by-nights beneficiaries of hype rather than reality. And the other half, the names you see decade after decade after decade. So from a value investor, if you're just prepared to be guided by fact, the historic performance of assets and management teams, you can pretty quickly work out with a high degree of certainty which are the ones that are likely to be there again in 5 or 10 years, not the ones that are going to be there once and then disappear. And I think we talked about last episode, the concept of dogs and unicorns. It's really hard to pick unicorns, but it is easy to understand dogs. And if you just avoid the dogs, your return will beat the market over time.
Ryan, I've been a bit unfair because I'm not assuming you're a value investor, nor am I assuming you only invest in megatrends. So just tell us a little bit about what what you do at Magellan, I suppose, and how you view megatrends right now, which ones you're exposed to, anything like that.
Absolutely. Look, as I've kind of touched on, we are looking for quality businesses at I would say attractive prices, or that we think are priced to a discount of their fair value. We wouldn't put that with a value label per se, but I think at the end of the day, you're trying to buy something for less than it's worth, and that's how we're going to generate attractive returns over time. So we're restricting our universe to these high quality businesses and then trying to understand what are the exposures to these mega trends. Where are we on the S-curve to that? If there's been a wobble on that S-curve, is that providing an attractive opportunity to gain exposure to it through this business? Example that I think's quite will be familiar to people is during COVID, we had this disruption in a lot of trends because it was such a massive event, and we had to bring forward of a lot of digital activity, and then we had to push out of digital activity as you went back onto that trend line. So for example, Netflix gained a lot of subscribers, then didn't gain so many subscribers when people got out of home, and people thought that was the end of the S-curve and sold it off and gave us a very attractive opportunity, for example, to buy into it. So as we think about those S-curves, are there wobbles along the way that give you an opportunity to buy that business at an attractive price and gain exposure to it? So hopefully that explains a little bit about what we're trying to do.
Yeah, great. Look, I think that this has been a really great discussion about megatrends. Really thrilled to have you here, Ryan Joyce from Magellan. Welcome back anytime. And Andrew Coleman, Team Invest, of course. Look, thanks to our guests. Now let's go head to head. Well, as you've learned more about megatrends, you know that they can dominate the market narrative. And as we've just learned, sometimes for good reasons. But do sectors continue to perform one year to the next, even if there is hype around them, even when the mega theme holds true? So let's find out what's behind some of the sentiment moves, how to look through them in markets, and why value investors often find their best opportunities where enthusiasm has faded. Andrew Coleman from Team Invest is here. Andrew, I didn't misstate any of that.
No, I think you did a great job. I think what's fascinating, our emotions are driven like a pendulum by news, and it's called news for a reason, not olds, right? We're constantly looking for new information and the next big thing. And I think that perhaps drives why we have such huge changes in valuations in the market in general, but particularly around megatrends. What is sexy and cool one week isn't going to write a headline the next week.
Yeah.
And therefore we see sentiment shift accordingly.
But I did like what Ryan was saying in the previous sector is that, or segment, I should say, is that megatrends, we think of those headline generators, AI, but it can be those quiet tailwinds that will persist for a long time. But I know that your research shows something interesting, that sectors that lead the market one year often lag the next. Why is that?
I think it's that human emotion we were talking about. So something will occur in a period, whether it's a news article, a change in technology, a change in financial services, regulation, whatever it is, that drives a huge amount of euphoria and greed into a certain area. And then the classic problem is because everyone has run together, the price of that asset, being driven by supply and demand, will rise and rise and rise until it reaches an unsustainable point. We've talked about it before, that image of Icarus flying closer and closer to the sun. And one day, we are still monkeys under it all. We will wake up as humans, look at the market and go, what's that thing doing that high? Even if it all comes off, it can't possibly justify that valuation, and fall it goes. And we do this again and again, no matter what it is. And it's common to human history.
Okay. So in 2024, and we've got a graphic for this, in 2024, the top sectors were tech, financials, and healthcare. A year later, it was materials, retail, and industrial. So what, in your view, explains such a dramatic shift, though?
Well, it can't be the earnings, right? Because the reality is the earnings of those sectors have moved pretty steadily through both periods. I mean, there was nothing in 2024 that made information technology earnings rise an average of 30%, which would be what would be needed for the PE to be stable and that much of the sector rise. And in the same reason, there was nothing in TMT that dropped at 30% on the ASX in 2025. What's driving that is the sentiment, the PE part of the equation. You know, prices are broken down to the objective, the earnings, and the PE, the subjective. Now, megatrends affect earnings. There is no doubt about that, the E part of the PE. But the way we interpret those megatrends, the sentiment drives the short-term share price. So in the long term, share prices are driven by earnings. In the short term, they're driven by sentiment. And realistically, anything that rises 25, 30% in a year, when its underlying economics have increased by, say, 8 or 10%, has to fall by the difference the year after. And vice versa, something that drops 30%.
And we've got a graphic that can show you 2025 as well, because you alluded to it earlier. There was quite a change in dominance.
Yeah, well, as you can see, those same sectors that were the big beneficiaries in 2024, earnings rising, sentiment rising, came off a huge amount in 2025. And the unloved sectors of 2024, you know, the worst performers in 2024 were materials and energy, ended up being the best performers of 2025. And again, that's normal. You know, if you take materials as an example, so that's metals, mining, that kind of stuff that I don't normally invest in, but it's a sector on the market. In 2024, we had commentators saying things like, the world will become only technology. Only technology companies will exist. Well, that's bunkum. I mean, the reality is you need materials to make things. So materials average PE multiples fell from around the market average of 20 down to the low teens and single digits. So no surprise the next year they bounce back. And the same thing with tech companies. You know, tech companies got up to valuations of 50, 60, 100 times earnings. Now they're back down around 20. And
so what you're saying is that this is not just about business performance. All right, let's take a look and see what holds for the ASX 50. So we bring that graphic up. This is the PEs.
Yeah, so I think what's interesting, so the chart we saw before was breaking up the ASX 50 and the Dow Jones by sector. So saying what happened over the last year, if you look at it on a sector basis, you know, industrials, materials, retail, etc. This is saying take that same data and take out the sector, take out the noise, and just look at what happened based purely on their starting PE. In other words, the companies that started the year beaten down on low PEs, how did they perform? And the companies that started the year with the market euphoric, this was exciting, it was going to grow forever, how did they perform? And well, not surprisingly, as we just said, with that mean reversion idea in mind, the companies that started on low PEs, almost all of them made a profit in terms of for a shareholder. You know, the share price rose materially on average of 19%, well above the market average, and those that were on high PEs fell an average of 9%. So from that point of view, I think we often overcomplicate things. You know, the megatrends are there. They affect the earnings of the company, no doubt about it. But from an investor's point of view, to buy into a megatrend on a high PE is still a recipe for poor performance, just as it would be paying a high price for anything is always a recipe for poor performance.
And it's sort of classic investor psychology that you can get too excited on the way up, but equally too pessimistic on the way down.
Yeah, exactly. I mean, Buffett, I'll have to get my second Buffett quote in. Buffett always says, you know, we want to be fearful when others are greedy and greedy when others are fearful.
So does that idea of buying cheap still work out over the longer term, or is it sort of, you know, year to year type scenario?
Yeah, well, of course, the longer the term you go, the more likely that the earnings growth of the company can exceed any changes in sentiment, which is really what you're looking for as a long-term investor. But having said that, buying a good company on a low price is always going to be a better investment than buying the same company on a high price. I mean, that's common sense. So what I've done here is I've had a look at the companies that passed our triage filters. Now, we've talked about that on the show, but that's really this idea of the companies that don't show at least one sign of being a dog on the ASX. And in this case, I kept it to a minimum 200 million market cap, so I didn't have too many companies to deal with. So there's about 60 in each sample. And I said, what if in March 2023, 3 years ago, you had just bought an equal weighting of that bucket of companies, you know, just the companies that don't show one or more signs of being a dog? How would you have gone and broke that up by PE? So if you'd done that and then you'd said, I'm only going to buy the ones that look cheap on a PE of less than 15 times, you'd be up 38% before dividends. And on the other hand, if you paid for the expensive ones, you'd still be up, but a much less exciting 9%. And 5 years ago, same exercise, the same companies don't show a sign of being a dog back in March 2021. And you'd held them till now. If you paid a lower price, you'd have tripled your money. If you paid a higher price, you're pretty close to doubling your money. So, you've still done very well, but not as good as tripling your money.
Mm-hmm. All right. So, Andrew, you often talk about mean reverting. So I'd like you to explain actually what that actually means for investors.
Sure. So mean reversion really simply is the idea that human sentiment swings from really positive to really negative, like a pendulum. And at some point in that cycle, it has to pass neutral.
Mm-hmm.
Start really high, come back down to neutral, end up really low, or vice versa. And so that swing of PEs, market sentiment, mean reverts. It goes like a wave. It goes up and then it comes down and up and down. And so if you just accept that at some point in the cycle it has to be average, then very easily you can predict pretty much where the share price is going to be 5, 10, 15 years from now, because at some point in that 5, 10, 15 years, the sentiment has to be average. And then you can just use a proxy of earnings growth to work out your return.
Okay. So, look, bottom line, does this mean investors should be cautious chasing the next megatrend?
Yeah, I think chasing any trend is a guaranteed way of losing money.
Okay.
What I would say to that, though, is don't ignore the trend.
Yeah.
I'm not trying to say here AI is not going to change the world or anything like that. That's nuts. It will, right? But it's just because a technology or a mega trend changes the world, it doesn't mean it's going to be a good investment unless you can still get the good companies at the right price. Certain companies will benefit more than others. There'll be risks that trigger. You should be aware of that. But at the end of the day, buying, something because it's sexy is a guaranteed way of losing money, not making good returns.
Okay, so here's something. We're getting to know each other well over the past few episodes. For a value investor, is it too simple to say that you should look for opportunities in the sectors that the market currently dislikes?
I think that's probably bang on. I mean, not all opportunities exist in sectors the market doesn't like. Sometimes there's individual companies that look like a wonderful investment in a sector the market likes. They just haven't cottoned onto that company. But by and large, most of your opportunities will come from being a little contrarian.
Okay, so we're getting back to basics. If an investor wants to benefit from these trends, these mega trends, call them cycles, and ways in which the world changes, what is the simplest rule they have to remember?
Wait about 18 months. So that hype cycle is really fascinating. It takes about 18 months from being identified to run all the way up to that peak of inflated expectations and come crashing down to the trough of disillusionment. So you've got about 18 months to work out what the real effect will be before the buying opportunity comes. Now, in the meantime, you've got to have quite a high degree of intestinal fortitude to watch the share price rising and not buy, because it's hard to fear of missing out, right? But it's going to come back down. And I mean, we were only on the program on the call a year ago, and everyone was asking me, because we like them as a company, Technology One and Pro Medicus, don't you feel a fool? You're not buying on the way up. How much are they off by a year later? Now, the companies themselves have grown materially in that period, but the hype went up, then they became old news, and the hype's come down. Now's a good time.
All right, well, that sets us up nicely for our next segment. Let's get to a viewer question because you asked. And we love answering questions from our viewers. I'm not sure if Andrew always does, but please, if you have a question for the team, please send it to wealthy@ausbiz.com.au. And I'm just joking. He loves answering your questions. And this one comes from a regular Ausbiz The Call viewer who writes, I understand your long-term view and the fact that resources stocks are cyclical, but are you ever sore that you've missed out on gold's record run or BHP's record highs? It takes a lot of patience to make up for the exponential rise some of these stocks have enjoyed. And he does add, keep up the good work, from Tom. Hey, Tom, I'll put that question to the man for you.
Yeah, I mean, look, there's always an element of FOMO, right? When you see something skyrocket. I think the challenge you always have as an investor, though, is not to focus just on what did one thing do, but ask yourself, number one, could you have predicted it in advance? Because if you couldn't, then it's like buying a lotto ticket. And number two, what did you do with the money instead? And my answer always to anyone who's been on the call or the show and has talked about gold and BHP is to say, well, you've done very well, and that's amazing. But there are plenty of other places you could have put your money in the same period where you would have got just as good a return or better with a higher degree of certainty. I mean, there's plenty of companies on the ASX that have outperformed BHP over the last 10 years. Now, I think BHP is a wonderful business. If I was to own a miner, I'd probably own BHP. But the nature of the business is such that BHP is never going to be able to get the kind of growth in earnings and therefore the long-term return for a shareholder as a more nimble, less bureaucratic, less cyclical organization. So if you take a snapshot of any 6-month period, sure, BHP may win or gold may win, but look over 10, 15 years and they don't. It's not to say they didn't make a good return for you. You might still be happy owning them. But on an opportunity cost basis, a wonderful company acquired at a low PE will beat gold, BHP in any decade you look at it.
Over that time frame.
Yeah.
Yep. And so you sleep well at night.
I do. Having said that, though, don't worry. I get teased plenty at barbecues from friends. I used to get teased about crypto. Now I'm looking forward to this Christmas because I'll get to say, see, I told you. But, it's that natural cycle, that hype that we talked about. It comes every 18 months. So there's always, as a value investor, going to be something in every 18-month period where you're sitting there saying, well, I'm holding the line because now's not the time. And have I held on too long? Have I missed out? The good news is when you've been doing this long enough, a few more months and you'll be right.
All right, Andrew Coleman, Team Invest. That was a good program. Thank you so much for joining us. Thank you for watching. And we'll see you on next week's edition of Wealthy and Wise.
We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Team Invest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.